So today, having mentioned that, stop trading the noise, the institutional market structure blueprint. Most of us are usually chasing after noise. Today, we want to end that practice completely. No more chasing after noise. And as I've said, I'm going to try to keep this very, very brief. Market structure mastery, reading the metrics of price action, or in other words, reading the charts. Reading the charts. My name is Denis Mwenga. I've been in this industry for what? I think 8 years now. Sometimes I lose count. But my focus is on risk management and disciplined trading. I'll try to simplify complex analysis into actionable strategy like what we are going to do today. Just simplify it. So welcome everyone to the market matrix structural trading framework. You can see this is a breakdown of what we are going to cover today. Institutional price action, how to think like the institutions, how to move like the institutions, the movers of price action, in other words. So this is not about indicators or guesswork. It's about understanding market structure. We're going to walk through 5 core pillars. Understanding the perpetual market cycle that repeats across all time frames. External versus internal zones, how to protect your trading zones from market noise and false signals, candlestick signatures, spotting valid breaks, minor and major shifts in structure, and of course, institutional execution. I'm going to look into that as well. But don't be intimidated by that language. Trust you me, I'm not going to use that language at all when we start looking at structure. Now, when it comes to structure, very, very important. There are 3 types of structures, okay? Uptrend, downtrend, and consolidation. When you open your charts, this is the first thing that should come into your mind like, hey, I want to identify, do we have an uptrend? Do we have a downtrend? Do we have a consolidation? How are institutions engineering this market? Every time you open that MT4 or MT5, your immediate technical assessment must be, which macro stage of the cycle is the market currently manufacturing? Question number 1 in your head. That should be question number 1. Not, are we buying, are we selling? Not that. Guys usually ask themselves that. Are we buying? Are we selling? Stop that. That is not the professional way of looking at it. That is the gambler's way or the greedy trader's way. Okay? The way is process. The right way is process. So, first step of the process is, what market cycle are we in? Okay? So, price action does not move by accident or random chaos, okay? It continuously manufactures through distinct phases. And you can see those phases: uptrend, downtrend, and consolidation. So we are going to look at those ideal phases. Ideally, how do these phases look like? Ideally. So uptrend is known as the bullish market structure. Downtrend is also known as the bearish market structure. Consolidation is simply neutral market structure. Range-bound structures, in other words. Downtrend, you have institutional marking down and distributing. Institutional distribution and accumulation of higher pricing. That is what we refer to as uptrends or bullish market structure. So we're going to start looking at the ideal versus the real matrix. The retail myth: textbooks show clean zigzag lines of perfect trends. This is a simplified model that does not reflect real institutional market behavior. But it's good to start with the ideal. Then we're going to look at the reality. Reality usually is charts are very messy, noisy, full of sharp internal pullbacks. So we're going to see, how do you alienate noise, signal from noise, in other words. Okay, so let's look at the ideal scenario first. As I've said, I'm going to keep this very, very simple, ladies and gentlemen. Let's look at the ideal scenario. So let me jump and share my screen so that we look at the ideal scenario. What is the ideal scenario? How does that look like? I want this to be as practical as possible. The ideal scenario. Okay. So forget about that chart. I'm just looking for a blank space. For a blank space, eh? So I'm looking for that blank space right there. Ideal scenario of A, we start with the uptrend first. That is the bullish structure. This is the ideal scenario. The ideal scenario is price moves in a zigzag fashion, right? Like that. That's a first swing. Then we have a pullback. Then we have another swing. Second swing. Yeah, it looks like a staircase kind of movement. Pullback. Another swing right there. And pull back. And another swing. I believe that's enough. That's enough for our explanation. Good. This is the ideal scenario of a bullish market structure. In other words, market or price moves in a series of higher lows. Okay, so this is a low. This is the first low. Okay, then the second low, third low. So this low here is higher than the previous low. So we call it a higher low. Okay, so we also had another low here, assuming. Okay, so this low here higher than the previous low. So a series of ascending higher lows. Okay, or troughs, or a series of ascending peaks or higher highs. So this is a high. This is a high that is higher than the previous high. Okay, this high here is higher than the previous high. Then this high here is higher than the previous high. That series, okay, this is the ideal market movement. And the opposite is true for a bearish market structure. The opposite is true for a bearish market structure. So, I hope you guys can see, by the way. Okay. So for a bearish market structure. So you guys have seen the bullish market structure. Let me see, by the way. I hope, okay. Oh, you can't see the drawing. My cursor is not moving. Okay. Sorry about that. Or are you the only one who can't see the drawing? Is it the same thing for others as well? Let me know, please, kindly.
Me too, I can't see.
Okay. Let me reshare the screen again. I think I have an idea as to why you guys can't see. Okay, stop share and then reshare again. Or alternatively, I think, yes, my notes. I think Zoom should be having a board somewhere. Post tools. Don't we have a whiteboard? Yes. Let's use the whiteboard. Let's just use the whiteboard. Trying to activate the whiteboard. Yes. New whiteboard. I believe everyone can see the whiteboard. It's loading. It's loading. Okay, now how do I draw on this whiteboard? Okay, it's reloading again. Okay, so now, okay. So as I was saying earlier, just looking for a pen here. Nice pen. Yes, you guys can see. You guys can see the whiteboard, right? You can see the whiteboard now. Good. Let's just use the whiteboard. So as I was saying, ideal bullish structure. Why is it not picking? Oops. Yes, the ideal bullish structure. Okay, it's not drawing. There's a lag. There is a lag. Okay, I think now it can be better. So this is the ideal bullish structure. We have price swing. This is the first swing, a pullback. Second swing, a pullback. Third swing, then a pullback. And then fourth swing. Okay, that is essentially what I was talking about earlier. So this is the ideal scenario. My thing is very, very okay. Let me just use a straight line to demonstrate this again. First swing. Now I have to go there again to the line and click on the line. I'll just stick to first swing. Oh. Anyway, let's just stick to the pen itself. Okay, so as I was saying, we have this, basically, we have a series of ascending troughs. These are a series of ascending troughs. A series of ascending troughs. So this is trough 1, trough 2, trough 3. Okay, a series of ascending troughs. So now, these troughs, we call them higher lows, because this swing low here is high than the previous swing low right here, high also than the previous swing low right here. So it's a series of ascending higher lows. I'm really trying to see whether we can draw without having to go back to, but it can't. That's why I liked the other tool, by the way. But it's okay, we're going to just use the pen. So that's the series. That's the series. Okay. So to delete, yes. The whiteboard is just blank. But on my end, I can see my drawings. How come it's just blank? What about now? Can everyone see the whiteboard? If the whiteboard is blank, let me know. Oh, yes. Okay, some of you can see the whiteboard, others can't. Still white, still white, still white. We can't see. The screen is frozen. Let me try this again. Let me try restarting it again. Okay, I know what to do. I know what I'll do. I'll come here, share screens. I will share the entire screen. Entire screen. Let's share the entire screen. Okay, you can all see my screen. Good. You can all see my screen. Now, since you can all see my screen, the next thing I'm going to do is, okay, there's something I need to stop sharing, I think so. It's technical thing is, So first, I'll just go ahead, share my screen. Don't worry, guys, we can always continue this on Discord, So don't you worry, even if we run out of time.
Why don't you use Google Meet?
Google Meets,
Yeah.
Can try Google Meets. Can try Google Meets, but not today. Okay. Let me just share the entire screen. Okay. So I'm sharing my entire screen. And from my entire screen, I'm also going to share my platform. There you go. Okay. Very quickly. Now I think we are on the same page. You can all see my what? You can all see my platform.
Yeah, it's visible now.
Yeah, now it's visible. Okay, good. Thank you. Okay, now you can see the drawing I'm making, right? Okay. So I'm drawing structure, bullish structure. You can all see that. I believe you can all see that now.
Yeah,
Sure,
we
sure.
can see.
Good. Perfect. Now we can continue. I think we have like 30 minutes to this event. Let me ask someone let me ask the technical guy if they can increase the time. So as I was saying, guys, this is very, very important to understanding structure. It's literally everything. It's the foundation. It's the foundation. I'm just trying to text him very, very quickly. Guys, bear with me because I don't want the webinar to be cut off abruptly. Please extend. Yes. Okay, let's see what will happen. Anyway, so as I was saying earlier, a bullish market structure involves price moving in a series of, this is the ideal structure. First of all, this is the ideal. This is just the ideal. So it involves price moving in a series of higher lows and higher highs. Higher highs are these peaks. Okay, those peaks, that's what you're calling higher high. Because it's a swing high. Okay, price swung higher, and that high is higher than the previous swing high. This low is higher than the previous low. So you can imagine it as a series of ascending peaks and ascending troughs or valleys, whatever way you would want to call it. So that is the ideal bullish structure. Now, the ideal bearish structure is simply the opposite. The opposite of the ideal bullish structure. So the ideal bearish structure, price is basically swinging in a series of descending lower lows and higher lows. So this is the ideal. So you have the first swing, pullback, or what you'll commonly hear as retracement, another swing, pullback, another swing lower, pullback, another swing lower, and then pullback, and then another swing lower. This is the ideal bearish market structure. So a series of descending what? A series of descending peaks and troughs. Okay, a series of descending peaks and troughs. That is the ideal. Now, what is the realistic scenario now when you come into the market? So you understand what structure is. Now, the realistic scenario when you come into the markets usually looks like this. Looks messy. Looks messy, doesn't look so clean. So ideally, in a bullish structure, you'll see price has swung higher, then chops around, swings up again, can come again down, chop around now again to the downside, does that, swings up again, swings up again. So this is ideal. Reality or ground, reality on the ground. Okay, so what we have is number one, internal structure, where you have multiple swings. We call that internal structure, where we have the ideal swing highs, like this swing high now, that is external structure. That's external structure. So you should be able to distinguish between internal structure, okay, these distortions or noise, and external structure. You should be able to distinguish between the two. That is what happens in the ideal market scenario. In the ideal market, in the real market scenario. In the real market scenario, we don't have those clean moves, staircase kind of formation or movement. That's not what happens. The opposite is true also for a downtrend or bearish market structure. So you have a swing high, swing low there, price does its thing, makes its noise, and then breaks lower. Moves her up again, can do a lot of things, a lot of funny things, before doing what? Breaking lower again. Okay. So this is what ideally happens. But structure is still bearish. Okay, so it is very, very important that you are able to distinguish between those two. Now, having said that, let's go back to our slide. Having said that, though I don't want to spend a lot of time on the slide, by the way, to be honest. Having said that, I really don't want to spend a lot of time on the slide because I really want you guys to, understand how things play out in the real scenario. At least we complete this webinar, you guys having understood how to identify structure. Okay, so as I was saying, the retail myth and the institutional reality charts are messy, noisy, as I've demonstrated the noise and the messiness that we have in the charts, in the real scenario. So this is what I was mapping out. So mapping out major external highs, major external low, and the structural boundary. That's what you need to map out. So the major external high, that is the absolute highest point price prints on a swing leg before a clear retracement happens. Okay. And external low, the absolute lowest point. And then we have these two absolute pivot points frame your external structure, which dictates your valid trading range for bullish setups. And that is essentially the image that we are looking at. So you can see the major external high, the first illustration that I demonstrated. And then we have internal noise, but I'm going to break that down further and exactly, how to do it. Okay, how to do it. Let me just jump and show you guys how to do it. Let's just jump to the charts. Let's work on the charts. Let's work with the charts. Okay, now, first and foremost, the trick is, guys, first, you start with a longer time frame. The longer time frame here being the daily time frame. Now, on the daily time frame, you pick a candle. You pick a candle. And the candle that you pick is the daily, on the daily time frame. So each candle here represents 24 hours of trading activity. 24. So we are going to use the daily candlesticks or the daily time frame trading period. That is 24 hours. To the highest price traded and the lowest price traded in a span of 24 hours to identify external highs and external lows. It's very, very important to identify the external high and the external low because when price, okay, so just a minute. Okay, so it will end. Okay. Nice, very nice. We are going to have a lot of fun. I really want you guys to really, really understand this topic. Really understand this topic. Doesn't matter how long I take. but the guys are going to wonder when they post it on YouTube. Anyway, as I was saying, ladies and gentlemen, this is very, 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 very important. You are using the highest price traded and the lowest price traded as your anchor points. Okay, this is price action. And price action, we are talking about highest price, lowest price, closing price, opening price. Okay, this is how the manipulation is happening in the marketplace. Institutions are looking at prices. They're not looking at candlestick shapes. This candlestick is this shape, it's this pattern, they're not thinking like that. They are thinking, okay, what is the highest price traded today? What has the lowest price been traded? What was the highest price yesterday? What was the highest price last week? What was the lowest price? I want you to think like that, to think like institutions. So remember earlier, now let's go back to the small diagram. So as I was saying, now this is, for example, your typical structure, bullish structure, for instance. This is your typical bullish structure, for instance. So we are saying this is the external structure. Here, external structure. Here, the major swings. Okay, that's your external structure. From where the swing began. So the swing, like for example, this swing here began here, ended here, and then we got the what? The retracement. Began here, this swing began here, ended here, and then we have the what? The consolidation or retracement. So we call this external structure. This, we call it external structure. This is external structure, external structure. Then we have internal structure. This now is internal structure, where we have the retracement. You see, that's internal structure. That's an internal structure. Traders usually confuse external and the internal structure, such that you think that price has reversed. You think the overall trend direction, which is bullish, has reversed once you see price moving away from external structure. Okay, and yet we still have the overall bullish structure. It usually confuses traders a lot. So the exercise that I want us to do when we're looking at the charts, when you're looking at the swing highs and swing lows, where we want to use, the highest and the lowest prices. We want to use this high and low price approach, or prices, highest and lowest prices, to identify external structure first. Okay, external structure first. We're going step by step. External structure. So as I was saying, the easiest way to identify external structure is by thinking of two prices: the highest price traded during the previous day and the lowest price traded during the previous day. Highest price traded and the lowest price traded. So now on the daily time frame, this is today's trading activity or candle. A candle is basically what? Representative of the highest price traded, lowest price traded, opening price for the day, and closing price for the day. But currently we cannot even say closing price because the day has not yet ended. Okay, markets are still open. So we are using previous day. This is the previous day, 24 hours of trading. This whole entire candle encompasses 24 hours of trading. Now the lower wick marks, this is the what? The lowest price traded yesterday. There, I'm marking it out there. And this is the highest price traded yesterday. Now, when I move to a time frame like the 1 hour time frame, you see on my chart, we have those broken lines. Those broken lines are called period separators. They're called period separators. So from here to here, that's 24 hours of trading. In other words, this daily candle, this one entire daily candle, has been broken down into intervals of 1 hour candle, 1 hour, 1 hour, 1 hour, 1 hour candle, until it's what? 24 candles, making it 24 hours. So this was the highest price yesterday, and this was the lowest price yesterday, just as I had marked here on the daily candle. This candle here, the highest, I marked the highest, and I marked the lowest price. Now that is what now you can say encompasses external structure. It's part of the external structure. Anything that is happening inside is internal. You remember our drawing. You remember our drawing, if I can put it into context again. You remember our drawing. You remember our drawing, we have bullish movement. Okay, you can see we have the origin of the move, and then we have retracement. Okay, now this is the what? Internal. Now, when we have price now breaking above this high here, yesterday's high, that is known as a break of structure. Okay, a break of structure which signifies a continuation of the bullish trend. Okay, which signifies a continuation of the bullish trend. So now, market is caught in what? In an internal range or internal structure. Yeah, that's internal structure. So how do you identify the internal structure? The internal structure is caught between what? The highest price of the previous day, the lowest price. If price action breaks below the previous day's low, for example, if that happens, then that is usually known as a CHOCH, or a change of character. A CHOCH, or a change of character. A change of character meaning now the bullish market structure is about potentially going to do what? To shift. And now the bullish trend is going to turn bearish. So we have a CHOCH. Then let's say we have a CHOCH today marking the lowest price today. Then again tomorrow we have, let's say, now another consolidation or internal structure, and then price breaks the low further. So this is confirmation that we have a what? It's pure confirmation that we do have a what? A complete change of structure of the overall market structure from bullish to bearish. Now this final break will be the what? The confirmation, because sometimes price can run up to that level there, break slightly, and then boom, move back up again, fooling traders who started selling here. And sometimes also again here, price can break below and then just halt and then boom, move up again, fooling traders who started selling here. Or traders who started selling when internal structure was broken. See, like for example, here we have internal structure getting broken here. You can see here we had internal structure here. You can see these candles here. We have internal structure getting broken. Then we obviously had some guys trying to sell, and yet the overall structure is still bullish. Why is it still bullish? Because price has not broken below external structure. This external structure, price has not broken below it. So that is where now institutions, tend to manipulate the market like that and fool traders who are impatient. That's why I said learning and understanding market structure will be very, very vital. Very, very vital when it comes to chart analysis. So looking at row charts now. I have separated now price action into intervals using now what we call the period separators, because I don't want to zoom back to the daily chart. I want to stick here on the 1 hour chart to just mark the highs and the lows. So now, where do I start? I can start from anywhere on the chart, anywhere. So now, and then we have consolidation. Like you can see here, we had consolidation, but I'm going to talk about consolidation. Now, here, let's start from here when we had a very sharp drop to the downside. So this was the highest price. Okay, this here was the highest price for that day. And then the lowest price there, right there, for that day. So we have a situation whereby the next day, now this day here, price is caught between the highest price of the previous day and the lowest price. And then you can see price, this move here, when you look to the left, you can see we broke below the previous day's low. See this low here? We broke below the previous day's low. So here we had what? A change of structure, whereby we broke below the previous day's low. But we are marking that high. If price action came and reached here, somewhere here, and then went back up and took out that high, then of course that will signify a false break and a continuation of a bullish trend, or the trend that was there. Maybe it was a consolidation, and now price action has broken to the upside. But that is not what happened. Let's look at what happened exactly. So now we have two external structures here. We have this high here and this low here, and that low. So this day we traded well, we traded nicely, and then that day ended here. And then we had the high of the day right there, right here. So we update. So that marks what? Our new external structure. Then we have the internal structure, and then this is the low for that day. And then we have our new external structure as well. Okay. So that day, the chart was looking like this in real time. In real time, this is how the chart was looking like in real time. So now I come in the morning, I see, okay, this is the previous day's high. I mark it out very well. I see, oh, this is the previous day's low. I mark it out very well. Okay. And overall, we have a what? We have a market which had broken below this low here, a very sharp sell-off. We had a very sharp sell-off. So the thing is, if price action continues to break lower, if it breaks below this low here, okay, comes, does its the kawaida thing. Let me use a drawing here. Does its normal thing. Sorry, apologies. I'm not supposed to even use Swahili, because this is going to be posted in the global page. Okay, now, does its normal thing. Does its normal thing in the sense that if we had price action coming and let's say breaking below there, that would signify a continuation of what? A real beginning of a real continuation of the downtrend. But that is not what happened. What happened was just price action did what? Just consolidated. In other words, created internal structure. And that is exactly what happened. You see, price action created internal structure. So my question is, will price action break above or break below? Price unfolds, boom, we break above. So that is a slight change of what? Change of structure or change of character. There's a slight change of character. We have a change of character. So since we have a change of character, I'll need price to break below this low here in order for me to invalidate this bullish move or move to the upside. So there we go. We have now updating this low here, and we have a new what? A new high here. So you can see we have a swing high there and a swing high there. Remember, a series of ascending highs. That is what we have. Now, since that is the scenario, as I've said, as long as price action has not broken below this low, my mind is I am looking to buy, because we have bullish market structure. So I am looking to buy. I'm looking to take advantage of buying inside the what? Inside the internal structure. Okay, I'm looking for that opportunity to buy inside the internal structure. Okay, price action moves on. So we have that low, then we have the next day here. This is the next day. So the highest price for the next day. So that marks our external structure. Then we have the lowest price, okay, for the, the lowest price for this next day. Again, marking our what? Marking our internal structure. external structure. Price internally consolidates, and then look what happens the next day. So the next day we have price action, this day here now, breaking slightly, just breaking below the previous day's low, the line that we have marked, breaking below it, slightly penetrating below it. But look at what happened. We penetrated below and then boom. That we never had a what? We never had a continuation of that break. By a continuation, I mean now the next day or during that day, in the course of that day, price never broke below this low. So this became the extreme low for the day. So what was this? This is what traders will call an inducement, a trap. A trap for those traders who are eagerly waiting for price to break below the low of the previous day and start selling. Only for them to start selling. Why are they starting to sell? You are starting to sell because you are confusing external structure from internal structure. You see, this, you saw a sell-off. You saw price selling off. You saw the first wave of selling, pushback, then selling. Okay? So you are confusing. You think that external structure has completely been damaged. But that is not the case. For external structure to be completely damaged, we would have the next day, this next day here, we would have price action breaking below the low, this prior day's low. That's why we usually say you have to be patient. You really, really have to be patient. You don't have to jump in. You have to be patient and wait to see if there is a real change of character, a real CHOCH, a real change of character. So now we had a scenario whereby guys got trapped, the guys who are selling here, who started selling because of that sell-off. They got trapped because smart money wanted to buy. And when smart money wants to buy, it is looking for where, so if you want to buy, you are looking for sell orders, where all the sell orders are stacked. So all the sell orders are stacked around here. So if I want to push a large volume in the market because I want to buy so many huge lots. I'm an institutional player, for example. I want liquidity. I want where there are so many sell orders, sell stops. That is the sell stops. When you start selling here, you have a stop loss around here. So there is ample liquidity there. So I'll come and dump all my buy positions where all the retail money is selling. And that's why you see this kind of sharp moves now. Okay. So there was no change of character there. Now, our new low, that is the lowest price for that day. And this is the highest price for that day. So until price breaks below this low here, let's say the next day, if this next day price breaks below this low here, if price breaks below this low, then I'll consider, hey, let me just be on standby and anticipate a change in direction or a change in character, a change of character, a change of the trend. That is really what a CHOCH is. But that is not the case. Price did again its thing, just went in an internal range. Okay, a range which is between the low and the high. So the internal structure, in other words. So it is here inside the internal structure where I'm really looking for an opportunity to place a buy position. Now look at what happened. I think is it yesterday? Yesterday. So now I've marked that high. I've marked that high there. So this day price never took out that high. Now again, update it to this new high here. And then the low there, the lowest price traded that day. Now, at the end of the day, we had price doing what? Breaking above that high, as you can see, breaking above that high. Still maintaining, you see, now we have a series of what? A series of swing, ascending ascending higher lows. So we have this low here, we have another higher low here, then we're having another one here. Okay. Now, until price takes out this low right here. Now, let me just remove this to avoid confusion. Until price takes out this low, that's when I'll consider we have a change of character. But price never did that. It broke structure to the upside, what we call a BOS, a break of structure. Broke structure upwards. Broke structure. Overall market structure is bullish. Printed a high. Now we have another new high right there. Printed a high. And we had a low, the lowest price for that day here, where that low here, as you guys can see, where this low here, here. So we went higher, up, broke the previous day's high. See this kind of push-up candle, Now, when we have this kind of push-up candle, market was consolidating, then the candle pushes up, it usually leaves behind what we call an order block. But we're going to look at order blocks in the next webinar on the 26th. Okay? Today our focus is on structure, not on order blocks, on structure. It is at the order blocks where we find ideal entry points, ideal entries within a structure. And I said, before you even start thinking of entry, execution, entry, you have to understand how to analyze structure. Please get that down. Before you even start thinking of entries, I didn't even want to mention the name order block because, with traders, you mention entries are based on order blocks and then everyone forgets about structure because, you want to start entering tomorrow and making money. It's a process, guys, but ideal entries are usually around what we call order blocks and fair value gaps, but I'm not going to touch on those topics. Okay, I didn't even want to mention. Now, our goal is to learn to identify structure. That's our goal for today. So now, you can see we have the overall bullish structure. We had markets breaking above the previous day's high here, this high. We had a very nice break above the previous day's high, which we call break of structure. Break of structure. Now, this marks the new line in the sand. If price breaks below that new line in the sand, then of course, that is considered what? A change of character. But what happened? We had internal structure. Remember I said this, the high and the low, they mark external structure. And anything that happens in between the high and the low, we call it internal structure. Okay. So now, this internal structure danced around and then you see price retraced lower and then moved lower to where we had what we call the order block here. It was close to the low of the previous day. And so here makes it an ideal entry point. And you can see what price did came, touched there, and then rallied. So now, this was yesterday's high. Okay, this was yesterday's high. Now, for us to make a judgment tomorrow, of course, we have to wait for the market to close so that we can determine, okay, for real, this is now the extreme low for the day, for example. I'm saying we have to wait for the markets to close to determine because I don't know. We might find the market, something might happen overnight and then the market just swings way lower. So we cannot say anything conclusively. But let's just assume nothing happens. Nothing happens and structure is maintained. So you'll have that low there. And then we'll have that new high here. So tomorrow, we can see now what will potentially happen tomorrow. What can we anticipate? In other words, what can we anticipate tomorrow? Okay, let me see what you guys are saying in the comments. Yeah, I'm calling it ideal because, okay, we'll come back to that. Let me focus first here, Mr. Walter. Let me first focus here. So now, assuming today's low is at that price, okay, this is Euro USD. What price are we talking about here? 1.1575 and 1.16179, 1.1679. Okay. So tomorrow, Tomorrow. Look, guys, one secret I'm going to tell you, and this is going to help your trading psychology big time. Do not bother trying to predict. Don't bother trying to predict and all that. Nobody knows the future. Anticipate. Try to anticipate. Forecast. Yeah, you can come up with forecasts. Yeah. You are forecasting. You are forecasting and you are anticipating. So that is exactly what we are going to do right now. So we are assuming that, okay, this is the lowest price for the day, this is the highest price for the day. So we have our external range. Okay, we have our external range or external structure. We have it. And we are saying scenario for tomorrow, most likely scenario. Where is my drawing tool again? I think I can use, yes. So we are saying we might potentially see a couple of things happening. We might see internal structure price just consolidating and staying within the internal structure, or a break below, or just like what happened prior. Oops, this is now what now? I don't like this zoom drawing tool, to be honest. Okay, so we might anticipate a break below. Like, you see the way we had this break here to the upside. We can anticipate a break to the downside. That will signify a potential change in what? Change in character. For example, here we had a break to the upside, price consolidated, then came to where the break had originated. This is where the break had originated here. Okay, let me just use let's say yes. So this is where the break had originated. You can see we had a break, then price consolidation, then we had internal structure, internal structure, then price found a what? Found a base there where the original break had originated and then bounced off. So if I was trading today, this was a move of how many pips? Up to that high there, up to yesterday's high. Yesterday's high would have been the target. That is around 40 pips. Let's say 40 for the sake of simple math. Let's say 40 pips. So if I was trading one standard lot, for instance, if I was trading one standard lot, price moved 40 pips in my favor, that means I would have made $400. If I was trading a mini lot, 0.1 lot, that means I would have made roughly, that is $40. For example, 1 pip movement when you're trading a mini lot is equivalent to $1. If you're trading a standard lot, 1 pip movement is equivalent to $10. Okay, so it will depend with the size of your account. If I'm trading 0.01, that is 1 micro lot, that would have been $4. Okay, that would have been, yeah, I think roughly $4 should have been $4. So now to anticipate tomorrow. How do I remove this thing? I don't want it here. Oh, let's see here. Okay.
Use the rubber. Use the
Oh,
rubber.
the rubber. Oh, the rubber. Thank you. I am used to Teams. Okay, good. So, guys, to anticipate what? To anticipate trading tomorrow. Let's anticipate tomorrow. Once again, let me use what I'm used to using. So to anticipate tomorrow, either we do have another internal range, internal structure formulating itself. Scenario number one. And yes, you can take advantage of that internal movement and look for an opportunity to do it, to go long. As long as I know if I go long, I have a low risk entry. A low risk entry means I can place my stop loss below a significant level. Like this low here, this low will be is a significant level. So if I can have my stop loss below that significant level. So see how price is behaving. So we might have price consolidating throughout the day, or we might see a scenario again where we have a what? A push up again. That is a continuation, the same way we had what we had earlier here. See what we had here earlier. You can see here we had a break to the upside, price action, took out this consolidation, and then we broke to the upside. So anticipating. We're not saying that is what will happen, what not, blah blah blah. We are anticipating. We are ready for any scenario. And as I've said, it's really about patience. Okay, this is the nature of trading. You see, there is nothing complicated in that. What's complicated about that? Nothing complicated at all. But what is going to waste you will be your lack of patience. Now, why was I calling it ideal? I was calling it ideal at first, simply because, when you look at the textbooks, when you look at some content on the internet, you'll see, market structure is price action, moving in swings, up and down, in that zigzaggy fashion. But we know in the real scenario, there is a lot of noise. Price just moves in a very, in a way that is, I'll say, so this is the ideal movement. Swing high, swing low, retracement, swing high. Swing low, swing high. Swing low again, retracement, swing high. That's the ideal, what you'll see. But markets move, so we swing up, then starts consolidating. Now the noise, manipulation. And then, swings lower, and then you think, you know what? You think, hey, you know what? This market is selling, by the way, so let me start selling. Okay, that is just an internal what? An internal change of character. Remember, external is this swing high here, and the origin of the swing high here, down here, until price action breaks below here, below. Until price action breaks below, that's when you can say we have a true change of character. But you can have all this noise. It's manipulation. It's simply manipulation being caused so that you start selling. And when you start selling, when you put in sell orders in the market, you're putting in sell orders, you have your buy stops, that is your stop losses, but you're putting in sell order. You are creating liquidity. You are creating liquidity for these guys who will come with their large orders and do what? And push the market upwards. You see? And that is exactly what happened here. We had a push up. Okay, we had this push up here. You see, this was the origin number one. We had also this push up here. This was also an origin here. We had a push up, push down, another push up. Then we had the noise. The noise now. This is the noise now coming in. The noise coming in. Price penetrated just a little bit slightly. Here, this nini here, these swings here, but never at all penetrated this key swing high here. Never penetrated that key swing high here. And then fooled everybody, and then boom. It will even be wise to wait until the end of the day to see, okay, will we have a complete change in structure, whereby will we have this movement that started here? Will we have it completely taking out, moving down, and then even pulling back, and then we have another leg as well? And that duration will require a lot of patience. So that is exactly what happened here. So we had guys getting fooled, you see, getting fooled. In other words, that is what we refer to it as a liquidity sweep or an inducement. You are induced to start selling only for smart money to push price to the upside. Then again, we had what? We had noise. We had a nice noise there, retracement, noise, and then push to the upside. And then our push to the upside, we were left with what we call the order block here. Okay, so the order block here, we're left with the order block. Then again, what? Noise. Then we had noise. You see the noise? You see this noise? here. This is the noise. So maybe now you saw this sell off here or this sell off here, then you started selling, 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 only for the market to come down again because it has to take out this key swing, this key level here. But that never happened, only for the market to come again and then push up and start pushing up again. So the fresh swing will be what? Will be today's so tomorrow we'll be focusing on today's now that is tomorrow we'll be focusing on today's low and the high, assuming that those are the points, those are the extreme ranges that price action will trade. Okay, let's go back to the slides and see what are the slides saying. But as I told you guys, I don't like spending a lot of time there on the slides. I enjoy spending time on the charts, but let's just look at the notes for the sake of it, I suppose. Let's look at the notes for the sake of it. Okay. Trading is very practical. But as I've said, guys, and I'm repeating this again, your trading psychology is the key to success. By psychology, I mean how you handle your emotions, how you handle your excitement when you see, oh, we have a break of structure. Yes, oh, we have a pullback here. How you handle that. How you handle that. So we have mentioned major external low, major external high, and the boundary rule. Everything inside these markets is internal noise. The market remains fundamentally bearish as long as price prints safely below the standing major external high. We have seen how to identify those external highs and lows. We have identified them. What else? We have identified them. Let's move on to the next slide. So we have defined the extreme anchor, break of structure, and the anchor zone. So as I said, the question that usually comes out, when structure breaks, which specific high or low becomes our official new anchor? Remember, I was talking about the highest price and the lowest price. The highest price, and the lowest price. So if you are a day trader, a short-term trader, you're starting your analysis from the daily chart. What if you're not a day trader? What if you are a position trader or a swing trader? You're not making your decisions based on the highest price. You're not going to define your external high and external lows. Okay, the external structure, the external high and the external low. You're not going to identify them using the daily time frame. You're going to jump to the weekly time frame. I'm going to use the weekly time frame. If you are a swing trader is someone who wants to hold a position for a couple of days, even a week. Let's maybe just say more than you're holding a trade for more than 1 day. You're a swing trader. But if you're holding a trade, if you're a day trader, it's by the end of the day, you're done with business. You close the books. Yeah, you close the books by the end of the day. And that's why we are using the daily time frame, the daily high and the daily highest price, let's say for the previous day, and the daily highest price. And we are basically making judgments right off the daily time frame. Whether we have compressed it into the 1 hour time frame, we are just looking at the highest price for the previous day and the lowest price for the previous day. So the newly generated major low in an uptrend or major high in a downtrend must be the absolute extreme point that triggered the expansion. Okay, you have looked at that. So price is moving from the low and pushing all the way up to the high. So those extremes. Okay. So the new structural anchor is, you must note, it must be the absolute extreme point that triggered the explosive expansion, not any intermediate pause or minor structure along the way. We have looked into that as well. Break of structure. Okay, a valid structural expansion. We have looked at break of structure. Break of structure whereby we had price breaking structure. Let's go back to the charts again. Back to the charts again. Break of structure where we have what? Price taking out the what? The high, like what he did here. That is called a break of structure. Look at the high, this high here. This is the high for this day here. We cannot say we have a break of structure here because you have seen a very huge bullish candle moving. Okay. Sorry, we have a break of structure here. If we look at the previous day to the left, if we look at this day here, can see this high. This was the highest high before the, okay, assuming this was what was happening in real time. Let me put it in that perspective. At the far right end of the chart. So we had this high here. This is the previous high there. And, oh, sorry. That's the high there. And this is the low. I have to change, I have to make some settings here, change. For me to draw a straight line. But I can draw a straight line. Parameters, remove the fill, say, okay. Let's just put this aside, I'll use it. Okay, so this high there for that day, what was the lowest price traded that day? I think this is the lowest price for that day. The lowest price right there. Yeah, the lowest price. So we're looking at the following day. So market does its thing. So we have marked that. So anything, any penetration above that will be referred to as a what? A break of structure. So we break below, but the day has not yet ended. So you cannot go ahead. Remember, you are a day trader. You want to make your decision as to buyers after the period of 24 hours has elapsed. So this whatever this break that is happened in the course of the day should not shake you. Should not shake you. It's just part of the manipulation process. It's just part of the manipulation. Remember, you are making your decision at the end of the day after 24 hours have transpired, 24 hours of trading. In this period of 24 hours, there is a lot of noise in the market. There is news coming out. There is geopolitics. There is greed, fear. There is just noise. Remember, the title of this webinar is, staying away from the noise, how to really stay away from the noise. As a technical analyst, you really need to understand how to really stay away, out of the noise. So noise happened. Then apparently we had a break below, but price action shifted and moved up, and then we closed. You see, we had a candle closing. This candle here closed. By closing, I mean the body of the candle was above the previous day's high. Okay, that's usually a good sign. Bulls are still what? Bulls are still very active. So that's also a break of structure. BOS, a break of structure. And then now we have another new external low and high. So we had a break of structure, then we had this high there. Then there we go, that high. And then we had a what? A break of structure. Again, this was early this morning. Early yesterday morning, we had a what? We had a break of structure right there. So that's what we refer to as a break of structure. And then you have the extreme low here, which marks the line in the sand. So if price action had yesterday, let's say yesterday's price action had broken below this previous day's low, if it had broken below it, if it just broke below it, and then this day starts and still price action is below this low, that will signify a fundamental change, a change of character. A change of character is happening, changing from that bullish tendency to bearish tendency. Okay, weekly time frame. Now that is for day traders. Now remember, we are looking at, if we break this down, you'll see we are marking the high, the low, for an entire 24-hour period. Weekly time frame. So the best time frame to transition from weekly, usually you transition from weekly to the 4-hour. Because on the 4-hour, if I put a period separator on the 4-hour, if I insert a period separator on the 4-hour time frame, there we go. So from here to here represents 1 week of trading activity. You see that whole entire weekly candle, that whole entire candle for the week, this represents 5 days of trading, has been compressed on the 4-hour time frame. And look at the period separators. So this is, let me clean up the chart. Insert my period separator, Control Y, and my keyboard. It is just simply helping me demarcate, a time period. So this was last week. So we had, this was last week's low. Sorry, this was last week. This is now this week. So we had last week's low. This is last week's lowest price. There, is it? Yeah, that's the lowest price for last week. This is last week's lowest price. And the highest price for last week. When was the highest price for last week? Let me go to this thing is confusing me. Here. I think the highest price. Let me go to the weekly time frame. If you get confused, just go to the weekly time frame. Mark it. So yes, I've seen it. I just want this line to be straight. So this is it. So last week's low, last week's high. Yeah. So this was last week's high. And you can see we had a break of what? We had a break of structure as the week began. So we had a break of structure as the week began. We've come back until price breaks below this low here. That's when we can start thinking about, oh, you know what? We now have a change of character. But now here we had a break of structure, meaning bulls are still in charge. If we fail to break this low and let's say price action comes back again inside here, we cannot start saying we have a downtrend. No, we have a what? Price action is doing what? Consolidating. Remember, the other structure is a consolidation. Okay, the other structure is a consolidation. So price action will just simply be consolidating. The best continuations is usually when you have a very strong thrust to the upwards. So if you are someone who was a swing trader now, you'll be looking at things from this perspective. And so that means you have to be extra patient. You have to be extra patient if you are if you're a swing trader. Okay, guys, let's stop at this particular juncture. If you have any questions, I think maybe you can throw in a question, and we can meet tomorrow also. Tomorrow's class will be on Discord. Tomorrow's meeting will be on Discord. I really hope this helps in analyzing charts. Remember, the goal for today is to analyze charts and specifically market structure. You are using extreme highs and extreme lows for that exercise. That's what you're using, extreme highs and extreme lows for that exercise. And I've showed you how to look at the extreme highs and extreme lows. I've showed you the minor change of structure and major change of structure. Okay, I have showed you the what? How to use the wicks and the bodies as well. Okay, so rule number 1, you must understand that structure is engineered. Structure is engineered. And market structure is engineered not at random. Every swing high, every liquidity sweep. I've shown you what a liquidity sweep is, that trap. Every CHOCH, change of character, is a deliberate institutional footprint The institutions making these footprints. Okay. Bodies versus wicks. Bodies close for structural validation. Wicks sweep for liquidity generation. Protect your capital. Okay, don't try and bother trading within that internal noise of the macro range. Okay, someone raised their hand. Go ahead. Okay, let me look at the chat section. Oh, what is the name of the app I am using to draw all those structures? I don't understand. I'm using MT5. I'm just on my MT5 platform. Yes, we have a recording of this webinar. It will be posted on YouTube. It will be posted on YouTube. Guys, today we had a very, if you understood structure, this was a very, again, I'm repeating this again. I don't want to confuse you guys, but I just have to mention it again. Today we had a very good textbook kind of trading opportunity. You see, you saw, you know what I was showing you guys. I want to go back to the chart. I believe you guys can still see my chart. Can you guys see my chart? I believe you guys can still see my chart. Huh? Yes, today. This was a very beautiful one. This one was just a classic move. You know, where we had, let me repeat it again. So we had this BOS here. We had this break of structure here. Price action came and landed, just landed. Oh, Ronald had asked your question. Go ahead and ask your question. Landed on this order block. He came, retraced, and landed on that order block and then took off. So usually, when price is about to approach an order block, you can zoom into, like, let's say the 15-minute time frame for you to get a sniper entry. You see, this is the order block here. Ugh, these other lines are just confusing us. Oh, this is the weekly. Just remove it very fast. Okay. You see this order block here. Price just came and landed on it nicely, took off. If you had executed here, you might had a stop loss of, let's say, 10 pips only. 10 pips, you have a stop loss of 10 pips, your target should be 20 pips to the ideal target, but market moved more than 20 pips, 29, all the way 30 pips. You're looking to target the high of the previous day. This is the high of the previous day around here. That's the high of the previous day. The high of the previous day. If you've not panicked out of the trade because of this retracement, we see price action has moved over 30 pips. So that means you have a risk reward ratio of 1 to 3 there. Assuming you're risking $1, you've made $3. That's usually a very good trade for the week. You can make that kind of trade and call your week, I'm done for the week. I'm just done for the week. You're trading one standard lot, that is $300, and you say, you know what, I am done for the week. You're trading 0.1 lot, that can be $30, and you might think $30 is a little when you're trading. No, it's not. It's not a little. It's progress. Because now if you have $30, for example, you have gotten a risk reward ratio of 1:3. You will need, if you maintain that risk reward ratio of 1:3, it will take, I don't know, 3 trades, 3 bad, terrible trades to wipe out your profit. We're not even talking your principal capital. We're talking about your profit. So you'll be on the safe side. Just don't overtrade. Okay, question from who? Let's take the last question before we call it a night. Ronald, I see Ronald.
Yes, how are
Um,
you?
yes, how are you, sir?
I'm good, how about you?
Perfect. I'm fantastic.
Yeah, so I was asking,
Yes.
like, how do you really know that this order block is really valid? Yeah, so that
Oh, now you
and
see, Ronald. Now Guys, this is what I was talking about. I don't want to go into order blocks, Ronald. I don't want to go into order blocks, but there are steps. There are 3 criteria that we use to identify a valid order block. And on the 26th, that is going to be the subject of conversation on the 26th. So mark that date. So the first thing we usually do, we identify what we call a displacement, whether there is a displacement, in other words, what we call a fair value gap. That's the first step. The second thing, we look at the previous candle to see whether the origin candle, we call it the origin candle, whether the origin candle has swept below the low or below the high of the previous candle. Below the low of the previous candle, if you're talking about a bullish order block. Above the high of the previous candle, if you're talking about a bearish order block. And then the displacement, and then the magnitude of the move. How explosive was the move? Like you see this move here. You see the way this move was explosive. It was very explosive. Yeah. This move, look at this move, very explosive. This is the origin candle. This is the previous candle. The origin candle managed to sweep below the low of the previous candle. Then we had an explosive move. And then price took out what? There was a break of structure. So those are the 3 criteria. 3 criterias. So yes, guys, please don't feel very, very confused. Ronald is way ahead of us, I think, but we are going to, of course, clarify, of course, what Ronald is saying. I had to answer his question, obviously, but on the 26th, that will be our subject of conversation. And just keep in mind, if you're entering trades right now and you're not doing it at order blocks, then, or what we call fair value gaps, then you are really, you're not on the safe side. You're not. So it's education, it's a process. So guys, let's meet tomorrow, same time, continue our course. Okay, it's a 12-day course. 12 days. It's like a boot camp. Get to understand the basics before we delve into these complex things. Get to understand the basics, lot sizing, position sizing, risk management, reading pips, such things. They are very, very, very important. I know sometimes you believe, oh, knowing how to enter is important, but yes, you can enter, but if you don't know how to manage your risk, you don't know how to calculate pips, you don't know how to use leverage correctly, you're not going to last for long. And you find people have awesome, good strategies. They can even explain those strategies so well, but they are not profitable. Why? Because they don't understand the basics at all. Very, very important. So we continue tomorrow, ladies and gentlemen. It's what, 30 minutes past 9. Thank you very much for your time. For those guys who are asking for the recording, this session will be posted on YouTube. Check out our YouTube, Valetax. Check out our Instagram page as well. We really put nice content out there. We usually do reels with short messages, on risk management, on trading strategy, on whatever the subject will be. Just check out those reels on Instagram, also reels on YouTube. Share them, spread them out. Let's spread the gospel. Check out our events as well. We usually have events on the ground. Can meet the team. Check out Valley Talks. Valley Talks is our flagship podcast. We usually do it every Monday, a group of educators doing Valley Talks. We also have a Signals Telegram group for Signals, but Signals, I don't mean, you go there and then there is buy now, sell now, buy now, sell, but a analysis breakdown. It's usually there on Signal. What else? Mentorship. Our mentorship, as I've said, it's free of charge. We do not charge for mentorship. No one is going to ask you for any money. And guys, let's do our best to start at whatever point we'll start. Start with that cent account. Open that cent account. Fund it. Fund it with $100. Multiply that by, I think, 100. I think so. Those are so many cents for you to practice, for you to learn. Use it as an account to educate yourself. Okay, because you are experiencing the real market, number one. So you are experiencing the real emotions in the market whereby you can be able to judge. You know what? I am not very patient. I need to be patient. I am very greedy. I need to be greedy at a very low cost. Your education will come at a very, very low cost. Yes. For those ones with advanced strategies, of course, we have the ECN accounts. Check out the ECN accounts as well. And for those ones who want to experience trading profits or want to invest, I suppose, as you are learning, copy trading is your answer. Check out copy trading as well. See the strategies that are there, the strategies that you can follow. Find them there. We have a series that is currently running also on trading psychology. These are matters education. Check it out. But yes, you want to start experiencing trading, copy trading is one of the ways to start experiencing trading without you doing much, and maybe you want to give yourself time to learn. So check that out as well. Reach out to our account managers for any support. Bring in more people. For those people who are interested in becoming partners with Valetax, also reach out to us. Reach out to us. Reach out to me. I'll connect you. Anyone you come across Valetax, of course, tell them I want to become a partner. I want to bring other people on board so that we can trade as a community, grow the community. It's only fun when we are many, when we invite others in this beautiful home that we have at Valetax. Okay. So thank you guys. See you on the next session. See you on Discord. Make sure you're on Discord. Sometimes I'll be posting trading ideas there. If I see those valid formations or setups, I'll be posting them there. Let's have fun there. And let's meet tomorrow. I hate saying goodbyes. I don't know how to say goodbye. So you see, I'm having a difficult time saying goodbye. There is a question. Okay. Who is asking the question? Who is this? I say Ronald. Is it Ronald? Or you lifted your hand by mistake? Okay. Okay. Where is the... You can go ahead and unmute. Okay. You can go ahead and okay, maybe you did that by mistake. So anyway, guys, cheers, goodbye. It's 5 minutes past 9:30. So I think that's a good place to stop. Be safe, watch your risk. Happy peeps, green peeps to you all. Green peeps to you all until tomorrow on Discord.